The lights are still on. From a distance, the skyline looks unchanged. Glass towers rise into the night, their windows glowing like they always have. To an outsider, the city still looks wealthy, confident, alive. But if you walk closer, if you step inside those buildings, you begin to notice something unsettling. Entire floors are dark. Elevators stop less often. Lobbies feel cavernous, oversized, almost theatrical. In some of the richest cities on Earth, the symbols of economic power are quietly hollowing out. In the United States alone, commercial office buildings were once valued at more than $6 trillion. They were treated as one of the safest assets in modern capitalism: predictable rents, long leases, blue-chip tenants. For decades, banks, pension funds, insurance companies, and city governments built their balance sheets around them. But today, many of those same buildings are worth 30, 40, sometimes 60% less than they were just a few years ago. And that raises a question that goes far beyond empty desks. If these buildings are collapsing in value, where does the damage really land? On investors, on banks, on cities, or quietly, invisibly, on everyone else? This is the story of how the global office market became a slow-motion financial shock, and why its consequences may define the next phase of the post-pandemic economy. To understand why office buildings matter so much, you have to rewind several decades, to a time when cities were designed around a simple assumption: work happens in one place. After World War II, modern economies reorganized themselves around centralized employment. Financial districts, business parks, corporate headquarters, and government offices became the engines of urban growth. Every weekday morning, millions of people flowed into dense downtown cores. And behind that daily ritual sat a powerful financial logic. Office buildings generated stable, predictable cash flows. Long leases, often 10 or 15 years, meant landlords could forecast income far into the future. Those income streams were then used as collateral. Banks lent against them. Investors packaged them. Pension funds relied on them to pay retirees decades later. For cities, offices were even more important. They anchored property tax bases. They supported transit systems. They sustained entire service economies, from cafes and cleaners to security guards and city maintenance crews. In many ways, office real estate wasn't just property, it was infrastructure. By the early 2000s, this system had gone global. London, New York, Paris, Frankfurt, Tokyo, Hong Kong, each competed to attract multinational tenants and financial capital. Taller buildings, more density, higher valuations. And with interest rates falling steadily for decades, borrowing became cheap. The math worked beautifully. Low rates meant higher asset prices, which justified even more lending. The system reinforced itself. Then came 2020. At first, the shock looked temporary. Offices emptied almost overnight as governments imposed lockdowns. Companies told employees to work from home for a few weeks. Landlords reassured investors. Banks offered short-term forbearance. The assumption was simple. Once the virus passed, everyone would come back. But something unexpected happened. Productivity didn't collapse. In some sectors, it improved. Commute time disappeared. Talent pools expanded. Employees began to demand flexibility, not as a perk, but as a condition. By the time vaccines arrived, the old equilibrium had already broken. Hybrid work wasn't an experiment anymore. It was a structural shift. And office buildings, unlike software platforms or labor contracts, cannot adapt quickly. They are fixed, capital-intensive, and slow to change. A tower built for 10,000 daily workers cannot easily function at half capacity. Heating, cooling, security, maintenance, those costs don't fall in proportion to occupancy. But the real problem wasn't emptiness, it was finance. Commercial real estate is valued based on income. When occupancy falls, rents fall. When rents fall, valuations fall. And when valuations fall, leverage becomes dangerous. Suddenly, loans that once looked conservative begin to look fragile. At the same time, interest rates began to rise. After more than a decade of ultra-low rates, central banks moved aggressively to fight inflation. In financial terms, this was devastating for office property. Higher rates do two things at once. They increase borrowing costs, and they raise the cap rate, the rate investors use to value future income. Even if rents stayed flat, higher cap rates alone would slash asset values. When you combine falling rents with rising rates, the effect is brutal. This is where the office crisis becomes something much bigger than real estate. Across the United States and Europe, trillions of dollars in office loans are scheduled to mature in the next few years. Many were issued when rates were near zero and valuations were at their peak. Refinancing those loans today often means higher interest payments on buildings that are worth far less than before. In a normal market, that would trigger defaults. Assets would change hands, losses would be recognized, prices would reset. But that's not what's happening. Instead, much of the system has quietly shifted into what insiders call extend and pretend. Banks roll over loans. Maturities are pushed back. Terms are adjusted just enough to avoid officially recognizing losses. On paper, everything looks stable. In reality, risk is accumulating. This matters because the exposure isn't concentrated among flashy global banks. It's sitting in regional and mid-sized institutions, the kinds that lend to local businesses, finance housing, and support municipal budgets. These banks hold a disproportionate share of commercial real estate loans. When office buildings falter, their balance sheets absorb the shock first. And behind those banks sit pension funds and insurance companies, institutions responsible for long-term promises to ordinary people, retirement checks, disability coverage, municipal workers' pensions. Losses here don't stay abstract. They eventually show up as reduced benefits, higher contributions, or public bailouts. Cities feel the pain even faster. When offices empty out, property tax revenue falls. Sales tax revenue follows as workers stop buying lunch, coffee, and transit passes downtown. At the same time, cities face rising costs, public safety, homelessness, infrastructure maintenance. The fiscal math turns negative. This creates a vicious cycle. As services decline, downtowns become less attractive. Businesses leave. Residents avoid the area. Vacancy rises further. What began as a workplace shift becomes an urban crisis. You can see this most clearly in cities like San Francisco. Once a symbol of tech wealth, its office vacancy rates surged after the pandemic. Entire blocks emptied out. Property values plunged. And with them, tax revenue. The city was forced to consider deep budget cuts affecting transit, housing programs, and public safety, just as social needs were rising. But this isn't just an American story. In Europe, office exposure is woven tightly into bank balance sheets. In countries like Germany and France, commercial property lending expanded rapidly during years of cheap credit. Now, regulators face an uncomfortable dilemma: force banks to recognize losses and risk a credit crunch, or allow slow deterioration that undermines confidence over time. Japan offers a glimpse of one possible future. After its asset bubble burst in the 1990s, banks spent years carrying zombie assets at inflated values. Losses were deferred, not resolved. Growth stagnated, productivity suffered. The system survived, but at the cost of dynamism. China's situation is different, but equally revealing. Its property crisis has centered on residential real estate, but the lesson is similar. When property values fall inside a highly leveraged system, the damage spreads quickly, from developers to banks to local governments. Office buildings may not dominate China's crisis, but the mechanics are familiar. What makes the office collapse especially dangerous is its invisibility. Housing crises are visible. Prices spike, rents rise, protests erupt. Office buildings fail quietly. Empty floors don't make headlines. Loan extensions don't spark outrage. The pain diffuses slowly, unevenly, and politically. And that raises a deeper question: who ultimately pays? In many cases, it's not the investors who captured the upside during the boom. Losses are often socialized through weakened banks, strained pensions, and underfunded cities. The workers who no longer commute downtown save time, but the service workers who depended on that foot traffic lose income. The benefits of flexibility are real, but the costs are unevenly distributed. This is where the story becomes human. Consider a small cafe owner who built a business around weekday office crowds, or a cleaner whose night shifts depended on full floors, or a city bus driver whose route was cut due to declining ridership. These people didn't design the financial system, but they live with its consequences. So what happens next? There are paths forward, but none are easy. One option is conversion. Turning offices into housing sounds simple, but it's technically complex and expensive. Floor plates don't match residential needs. Plumbing and light access are often inadequate. Zoning laws can slow progress for years. Still, in some cities, conversions may offer a partial solution, especially as housing shortages intensify. Another option is restructuring. That means accepting losses, writing down asset values, recapitalizing banks, allowing new owners to step in at lower prices. Economically, this is often the healthiest path. Politically, it's painful. The least visible option is delay, extending loans, masking losses, hoping demand returns. This avoids short-term shock but risks long-term stagnation. History suggests it rarely ends well. Ultimately, the office crisis forces societies to confront a broader question about how modern economies adapt to structural change. Work has changed faster than our financial systems. Cities were built for one model of productivity, but technology unlocked another. The mismatch between those worlds is now being priced in, slowly, unevenly, and often unfairly. The glass towers still stand, their lights still glow, but they no longer mean what they once did. What looks like a real estate story is really about incentives, power, and who absorbs risk when systems break. It's about how societies distribute losses when assumptions fail. And it's about whether we choose to confront reality early or carry it quietly until the cost becomes unavoidable. Because the question is no longer whether the office market has changed. It's whether our institutions are willing to change with it. And in that answer lies the future of our cities, our banks, and the economic lives built between them. There is also a political dimension to this collapse that is only beginning to surface. Office buildings sit at the intersection of private finance and public governance, and when they fail, responsibility becomes blurred. City leaders are pressured to keep downtowns alive, not just for economic reasons, but for symbolic ones. A half-empty financial district signals decline, even if the broader economy is still growing. That fear pushes governments towards subtle interventions, tax abatements, zoning flexibility, emergency lending facilities, designed not to fix the problem, but to delay its visibility. Yet delay has consequences. Every year a city props up unviable office assets is a year it diverts resources away from schools, housing, and public services. Every loan extension that keeps a building alive on paper crowds out capital that could fund new forms of growth. In this sense, the office crisis is not just about decay, it's about opportunity cost. What cities choose to protect tells you what they are willing to sacrifice. At the national level, policymakers face a similar trade-off. Allowing a full repricing of office real estate could destabilize banks and spook markets, but preventing it entrenches a system that no longer reflects how people actually work. The longer this tension persists, the more distorted economic signals become. Prices stop communicating reality, risk stops being priced honestly. And when that happens, trust, arguably the most important asset in any financial system, begins to erode. What makes this moment especially fragile is that it coincides with broader pressures already weighing on advanced economies. Aging populations are straining pension systems. Climate adaptation demands massive urban investment. Housing shortages are intensifying social conflict. In that context, the slow bleed from office real estate doesn't appear as a single crisis. It appears as a chronic weakening of state capacity. Budgets get tighter, choices get harsher, political polarization grows sharper. For ordinary people, the effects are subtle but cumulative. A city raises transit fares, a public library reduces hours, a local hospital delays upgrades. None of these are headline-grabbing events, but together they reshape daily life. And because the source of the problem is abstract, commercial real estate valuations, interest rate policy, refinancing risk, it's rarely understood as a collective issue. Frustration grows, but accountability remains diffuse. This is why the office crisis matters, even to those who never set foot in a corporate tower. It is a reminder that modern economies are deeply interconnected systems. Decisions made in boardrooms and bond markets eventually ripple outward, touching neighborhoods, families, and futures. The buildings themselves are just the physical expression of those decisions, concrete and glass containers for financial assumptions that no longer hold. History suggests that societies tend to misjudge moments like this. Structural shifts often look temporary until they are irreversible. By the time the consensus changes, the costs are already locked in. The real test, then, is not whether office demand returns to pre-pandemic levels. It is whether institutions can adapt quickly enough to avoid turning a manageable transition into a prolonged decline. Because once a city loses its economic gravity, it is far harder to rebuild than to preserve. And once trust in financial and public institutions weakens, it takes generations, not stimulus packages, to restore.